Yeah, so I think for someone who is just investing in stocks, that they would definitely need to diversify their portfolio.
Welcome to Investing for Generational Wealth. I'm Keshav Kalor, and not joined by my co-host, John Mai, actually. So it's just me today from Claf Capital, where we help high earners just like you invest outside of the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income or cash flow, and tax benefits. Together, we have helped our investors passively invest into over 1,000 apartments under renovation and 500 single-family rental homes. And soon we hope to be expanding into other asset classes, including industrial real estate and private lending and oil and gas, primarily for the tax benefits. Before we begin, a quick disclaimer: we're not financial, tax, legal, investment, any such advisors. All investments are subject to risks, including the possible loss of the money you invest. So perform your due diligence before making any financial decisions. And of course, consult your CPA, your attorney, and other professionals in your network before beginning investments. My friend Aaron and I here, we are not those professionals for you. We are just a couple of friends chopping it up on this podcast. This is purely for educational and entertainment purposes only. So I'm your host, Keshav Kalor, and welcome to today's episode, the benefits and risk of a multifamily syndication and the process of what goes into a value add opportunity. Today's guest is Aaron Thomas. Aaron, thanks for being here with us today.
Yeah, appreciate you having me on. Happy to be here.
Yeah, so let's get right into it. Could you introduce yourself, just kind of talk about your background, where you started, and then how you got to where you are today?
Yeah, definitely. So I think my journey's definitely been a little bit abnormal. Grew up in uh, uh, Michigan, and then went to college in Grand Rapids, Michigan, at Grand Valley State, which is a little bit smaller school in Michigan. And while I was there, I was actually studying medical science to eventually go to medical school was the goal while I was in college, and ended up going from there to Chicago to get my master's. And while I was going throughout my master's program, I was applying to medical schools. And really throughout that whole journey, COVID started to hit and started to flip some things upside down. So actually, while I was applying to medical schools, I started to hear back from them, started to really start to debate between what I really wanted my future to be, because my master's program was similar to year one of medical school, and really just took a took a hard look in the mirror while COVID was currently happening and everything stopped. So at that point, kind of took a hard reflection on myself and really started to read a lot more. I know a lot of commercial real estate investors. It all starts with that little purple book of the uh, the Robert Kiyosaki series, and really started to just dive into the world of real estate, because I always knew, even if I were to pursue my medical aspirations, I knew I wanted to use that salary or that money to eventually invest in real estate down the road. So I have some family friends and a good network of people that I know in the commercial real estate industry. So I started to reach out to a lot of them throughout COVID and really just started to pick their brains about real estate. And honestly, just fell in love, saw the benefits of working in real estate and really where an investing career can take you throughout your lifetime. And kind of just took a full leap of faith and dove into the real estate world while I was still hearing back from medical schools. I deferred a few, put it on the back burner. I said, okay, let me give myself a year to see if I want to continue pursuing real estate or if I want to go back to medical school the following year. So from there, ended up working in the commercial real estate world as a broker for Marcus Millichap in Chicago. loved my time there. And as I was working there, I was working closely with my mentor as well, who runs a syndication firm based out of Ann Arbor, Michigan. And just talking with him, learning from him of really seeing where I could grow in terms of the real estate world. I completely got wrapped up in it. I fell in love with the real estate syndication world. And then from there, just hit the ground running. Me and my brother started up our own company, Twin Lux Capital. And then from there, we moved out here to Scottsdale, Arizona, where we currently are, and bought a few short-term rentals that we are running as Airbnbs and VRBOs and such. And we've been doing that for a few years, and now we're trying to take our next step of moving more into the real estate syndication world. So we're currently limited partners in a few deals right now, and then we're working on hopefully here in the near future. We got some good news today, and we're working closely with a group out here in Scottsdale, Arizona, to co-GP a deal hopefully coming up here in the near future.
That's exciting stuff. What's the exciting news? I guess that is the exciting news. Okay. Yeah.
Yeah, that's exciting news. Working on getting some final documents closed up and getting the PSA signed, and then getting the marketing information out to our investors, and then getting the ball rolling.
Remind me again where in Michigan you're from. I know we talked about this a bit.
Yeah, so south, about a half hour south of Detroit, downriver area of Woodhaven, Trenton area, um, about 25 minutes from Ann Arbor, right where my brother went to school, and where we spend a lot of time going to some football games and rooting on the Wolverines.
Nice. Yeah, I know we mentioned
Yeah.
I lived in Detroit and worked from July 2019 to September 2021 in Royal Oak, the Auburn Hills area. And that's where I got my
Yep.
start in real estate as well. Read the Purple Book, Rich Dad Poor Dad, inspired to me to become a realtor so that I could start buying single family homes. And it all started in Detroit.
Yeah, I feel like a lot of people that I talk to are just in the world of real estate. It all starts with that little purple book, and it just helps. I know I've talked about it with other investors and other people in the real estate world as well, but it's almost just like a key to kind of unlock your mind of saying, why haven't I been doing this sooner? What can I pursue right now? Like as soon as you read that, you're like, what can I do right now to start this journey? Because it really just helps open your eyes to the world of real estate investing. And then once you get started, you don't want to stop. And it's just a beautiful path to generational wealth, like you mentioned, of starting this podcast and starting this webinar series that you mentioned is such a great pathway to really help investors to earn that generational wealth and that passive income that I know everyone is looking for.
Yeah. And when you started out, what made you want to choose a multifamily versus, in real estate, there's a lot of asset classes, right? There's industrial, self-storage, office. I wouldn't blame you if you go to office, but, senior
Yeah.
living. So why multifamily?
It was always tough for me because whenever I was deciding, especially whenever I was a broker, it was easy to see the transaction volume that there was in the multifamily space, while other sectors might not be as fast moving. Where I also see multifamily, it's really easy to understand because like a home, in terms of just real estate, when people think real estate, they just think, oh, houses, maybe apartments. Maybe don't think as much as self-storage or retail or industrial, which I mean, they're all great asset classes. I know industrial is still on fire and has been doing great over these past few years. But for me, I feel like it's easier to really wrap your head around because I know a lot of people say it, everyone needs somewhere to live. And it's just one of those assets that you know is going to be consistent throughout any economic cycle. It's always going to be there. People are going to be paying their rent. And just seeing what you can do to a property in terms of maybe what we're going to hit on today of value add of you're able to go into certain complexes and see, okay, what's maybe a little older, a little worn down. What do you need to do to maybe give this place a facelift to make it look better? And I feel like my mind just works that way. And it was really easy for me to decide to go into multifamily just because it's comparable to our short-term rentals that we're running. You want them looking nice. You want people and guests in there day in and day out, and you want that consistent cash flow. And in terms of multifamily real estate, you really see the same thing. But another big factor whenever you talk about multifamily is that depreciation factor or just the ability to ultimately raise rents and increase the property's value very quickly. So, in my eyes, there was just so many benefits to multifamily real estate. And from there, didn't want to turn back and just honed in on it.
Okay, that makes sense. So walk us through someone who's listening, they've only been in the stock market. What is multifamily value add? What does it look like to be an investor? How do the deals work? I guess they would like to know, how do you come across these deals? And then what is the process you go through before you bring it to a potential investor? What are all the steps involved?
Yeah, so I think for someone who is just investing in stocks, that they would definitely need to diversify their portfolio. But I know that's just a common thing that people think of. Okay, I'm just going to invest in stocks, bonds, just their IRA, just put it in a safe, small, they're maybe earning a couple percent on it every year, where you don't really think about being able to acquire a large real estate asset, such as a 100+ apartment building, where many people that just have their money in those certain asset classes don't think it's attainable and really don't that go into real estate investing because yeah, maybe earning 6, 7, maybe 8% in the stock market, but that fluctuates year to year and you never really know what you're going to get. Where in terms of commercial real estate, you're able to partner up with a group of like-minded individuals who are going to pool their money together and are going to buy this complex and ultimately run it for 3, 5, 7, 10 years, however long the whole period may be. But typically, you see anywhere from 15 to maybe mid to low 20% IRR returns on your money while you're also able to accumulate that depreciation and tax exemptions. So a two it's a two-way or double-edged sword that's killing for you, honestly. It's helping you earn more back on your money instead of just sitting in your account getting eaten away by inflation. If it's just sitting in a savings account, inflation's just killing that. That's another benefit of commercial real estate syndication is your money's constantly working for you. It's biting off against inflation while also returning you very high yield returns on your investment. So it's just a great place to really put your money to constantly accumulate passive income and work towards that generational wealth because most people in the stock market, they just put it there and they're not even thinking about it, where it's earning those low percentages and you could be earning double percent of your money while getting tax breaks in the real estate world.
Yeah, that makes sense. So what goes into actually investing into a multifamily value add deal? From an investor's perspective, how do you find a deal? What work do you go through before you bring a deal to investors?
Yes, so it's constant underwriting. You're always looking at properties, talking to brokers, seeing what's on the market, what properties are currently trading at, what their selling for, what people are buying them, what certain cap rates are at, or just seeing where the market's at in general. And you're just constantly running this market analysis. So you may run numbers and underwrite 100 deals and maybe find one or two good ones in a month where you think, okay, maybe this is something to that's decent enough to move forward on, and maybe you want to put an LOI in and maybe learn some more information on. So it's constant underwriting of, okay, figuring out where market rents are at, what this building is selling at per unit, what kind of, and then you're constantly looking at comps. So it's almost similar to that in a smaller real estate scale of just looking at houses when, let's say, like you're doing a fixer up, you're like, you're thinking, okay, what can I bring value to this home to ultimately increase? And then what are other homes around the area selling for? Are they comparable to this home that I have? So in that sense, it is pretty similar. But also for myself and my brother in Twin Lux Capital right now, we are doing more of a fund to fund program and SPV model where we are pooling together capital and we're working with sponsors or investors who are constantly underwriting deals. And then once they find a good deal, they're bringing it to us to then look over and see if it's something that we would also want to join up in and partner with them on to see if it's something that we would want to invest in ourselves and if our investor base would want to invest in. So we're currently underwriting deals that are just out there on CoStar, LoopNet, Crexy, really anything we can get our hands on while also talking to brokers to see what's out there and what we can look at. And then from there, it's really trying to figure out, talking to our partners and figuring out if this is a deal that fits within our parameters, within our risk tolerance, and is something that we want to go after here in the near future.
So once a deal passes your underwriting test, what else is involved into getting it to the closing line?
Definitely a lot of legal, which we have partners that help with that. But really, once a deal works or you think it's going to work, and then you have it underwritten, the numbers look good, you then want to the sponsor will then sign a letter of intent to the seller to ultimately buy the property. But from there, you then have about 30 to 45 days to run your due diligence just to make sure all the numbers actually do check out because whenever you are out there, I know people that definitely there's brokers out there, there's sellers out there that like to fix some numbers up, cook some numbers up, and make a property look a lot better than it actually is. So you just want to do all the background research that you can to make sure, okay, these these rents are actually at market or whatever the market is at is what they're getting paid at. And you want to make sure just everything's in line, nothing's hidden. You want to make sure the property's in good shape and just running your due diligence of diving through the deal to make sure, okay, these are the actual numbers that we do see. And from there, you can move forward past due diligence into the next stage.
Okay. And then so you found the deal, do your due diligence on it, walk the property, make sure everything is as you would assume it is. Close on it once you've raised investor capital and you go through, all the title paperwork, all legal work, all that fun stuff.
Yeah.
Once you close on a property, what does the work look like for a value add deal there? Like take us through a life cycle from, hey, you closed on a property all the way through a sale.
Yeah, so still throughout that process, you're always looking at, okay, where can I add value? Maybe you want to see how many rents have been renovated or how many units have been renovated recently, and how's the clubhouse if there is one, or what's the property management team that's currently in place? Are they underperforming, or is just the property itself underperforming? So looking at just all these different units of trying to see, is this something where we can add value? Once you're past those stages, you then move into the process of, okay, maybe we need to add landscaping, add a dog park, maybe update the clubhouse, maybe work with the property management team who maybe was there and wasn't doing a great job, and you possibly replace the property management team who are a little more focused and determined to ultimately help increase rents and really build your complex into a place where people want to live and enjoy their time, and really where you want to see people flourish. Because if you're just once you're treating it like a home and you want it to be at the best it can be, and you have a great team around you who really feel the same way, you're going to see just a lot more hard work go into it and a lot more dedication. And once that happens, you're going to see units starting to be renovated. You're going to get contractors in there, and it's all about a renovation timeline ultimately to see, okay, maybe unit 201 is going to be vacant from February 1st to March 1st or later, and you're just going to block off timelines for each unit that you want to renovate. So you can ultimately just have a small gap, but you want to stagger it just so you don't have all 100 units empty at the empty at the same time where while you're renovating the whole property. So that's why it's different based on the timeline of the whole period for 3, 5, 7 years, just to ultimately get into each unit, however the timeline works, to bring those units up to a higher scale so you can ultimately charge a higher rent, but also increasing the property as a whole, like I said, in terms of dog park, community center. So people actually want to pay that rent and live there. And ultimately just wants to be a place where you would say, I would want to live here. I would live. And once you have that comfortable feeling where you see things are really starting to do well and rents are rising, from there, that's when you're moving more towards the exit strategy. But throughout that period, it's really just working with the contractors of updating the units and the property management team to ultimately fulfill their unit goals as well.
Okay. How do you, once the property stabilized, like you've gone through, renovated everything, updated it, brought it up to market condition, increased the rents, improved the profitability of the apartment building, how do you go about exiting, right? How do you go about selling? What are the things that you consider? What's the process there?
Yeah, so really can whenever you're consider selling, I know it's common that if it is a broker, if you bought the deal from a broker, it's normally common to have that broker on your side whenever you're exiting the deal. But whenever throughout this entire period, investors are also receiving maybe monthly, quarterly checks throughout the hold period. So throughout that entire time, investors are seeing a return on their capital and moving towards that exit strategy is when I know a lot of investors get happy because that's really when the big payout is coming, because your exit strategy is normally always set in place before you even take control of the property in the first place. So you want to know really what cap rate you're going in at, and really what you think the exit cap rate's going to be at, what you think ultimately the sale price is going to be, because I know recently there is that a large buyer seller gap, but you want to sell your property for a fair market value. You don't want to be over asking, or you don't want to come in too low. You want to work with a broker who's definitely going to help you bring it out at a fair market value, who's going to do a lot of the similar things that we do while underwriting, of finding comps, really figuring out what's going on in that area, in that certain market to figure out, okay, this is what price we should come out at, because ultimately that exit strategy is huge for the investor base because that's when the waterfall structure comes in, and that's when hopefully you're seeing higher returns, or the sponsor maybe undersold and overperformed on the deal. But throughout this entire process, you're going to be hearing from the sponsor from a quarterly or semi-annual report, while also receiving some of that initial capital back. But in the back end is really where you see the large capital return to the investors.
You mentioned a waterfall structure. Could you walk us through what that means and an example of what a waterfall structure looks like?
Yeah, so really, I know that's a big key focus whenever investors are looking at deals, because there may be certain deals that say we're going to do 20% IRR, 2% equity multiple, or just running through all their number analytics, but also understanding the waterfall method is a great place for investors to focus on as well, because it just shows, if it's set in place correctly, it shows that the sponsor and the investor's interests are aligned. Because normally, whenever you're exiting a deal, let's say the preferred return out to the investors is 8%. So up until that 8%, when you're exiting the deal, all the investors are going to be receiving capital up until that 8%. And then let's say from 8 to 12, it may be an 80-20 split between the investors and the sponsors, with the investors always having the larger chunk being paid out. So it could be 80-20 from 8 to 12, and then 12 to 15, 70-30 in favor of the investor, and then 15 to 20, maybe 60-40. And then if you're getting over 20, it's maybe 50-50. So just showing those interests are aligned with the investor and the sponsor, showing that if the deal performs well, then the sponsor has a higher payout as well. So they're trying to get the highest return back to the investors as possible, because that means they make more money as well. So just being able to really look whenever you're looking through deals as an investor and you're getting sent deals, just looking at the waterfall is a great focus to really pay attention to.
What's a typical waterfall structure that you and your partners employ on your multifamily value add deals?
So typically you'll see, like I mentioned, 8-9% is the typical preferred return. And then from there, it may go to 12 to 14 doing that. It depends, honestly, maybe an 80-20. And then from there, it keeps going, like maybe every 5% it splits down. But also what I mentioned earlier at Twin Lux Capital, how we bring funds to deals and we're doing the fund to funds or SPV model. Whenever we partner with a sponsor, we're funds to a deal. And once we do that, instead of just a single investor investing in a deal who's maybe just the basic 8% preferred return with the normal waterfall, once our group, if once we pool our money together as a single entity, as a SPV, and then bring that to the deal and sponsor and partner with the sponsor, we then have beneficial metrics where, let's say if it's an 8% preferred return, we get bumped up to a 9%. And then on the back end, instead of it being an 80-20 split, maybe it's a 90-10 split in that first mark. And then if it was 70-30, then it would be 80-20, while our group is always receiving a majority of the fund. So that's a benefit that we see while to partner with us, because we get those better metrics on the back end, which really adds up in the long run.
Got it. A question I keep forgetting to ask is, are you and your brother Jacob, are you guys twins? Is that where the name Twin Lux Capital comes from?
They are twins somehow.
Nice.
He's he might be about 6'4". He's a little He's a little freakish in nature. Well, but I got the looks, is what I like to tell him. He's got big man's disease.
You guys are, I guess that's what, fraternal?
Yeah,
Uh,
fraternal, luckily, because I don't know if I'd be able to bear myself if I looked like him.
well, hopefully he doesn't listen to this episode. Uh,
Yeah, no, but it's great working with him. I mean, especially working with family, especially your twin. I mean, we've been by our sides for life. So it really it's not that big of a difference working with him. We're definitely different people, but we have similar mindsets, which helps. And yeah, I love working with him, and it's been great going throughout these past few years and seeing both of us progress in the commercial real estate world, and definitely looking forward to the future.
any advice you'd give for people, because you're in an interesting situation, for any advice you'd give people about working with family or friends in this business, working with or investing with? Like, what has your experience been there?
Yeah, I would say you definitely have to do your own research. You can't just count on someone else of thinking they have everything figured out and they have everything planned, because it always is skeptical, because I know working with family and friends is really how I got into the business of real estate. And it's great to work together. You learn from each other, and it's just great to feed off from each other. But whenever you are with someone else, if it may be family, you just have to know where your strengths are, where your weaknesses are, and what someone else's strengths and weaknesses are, just to be able to complement one each other. Because I think that's really great for me and my brother, because we really are different in a lot of ways, but our strengths and weaknesses really complement each other well. So that's a huge focus whenever we were going into business with each other, of just kind of knowing what our roles are, because you can't just sit back and I don't know, just think it's all going to work out fine, because you're going to have tough times. There's going to be bad things that just always happen. You can't stop it, but being able to rely on one either to really get through those times and figure out just a game plan going forward is a huge focus.
Nice. So when you guys are looking at these deals, what's your buy box? What's your criteria? You mentioned that, you obviously do underwriting, you're selective about the deals that you do take on. What kind of deals do you take on? What do you look for?
Yeah, ultimately it comes back to that last question. In terms of the deal, I mean, you always want to make sure it's a good deal, but then whoever you're partnering on the deal with as well, you want to make sure that your interests are aligned, that you're compatible, you have the same vision, because it just there's so many deals out there and you really never know what's gonna work. And it's more of you just want to know who you're relying on. If this is someone who has done 100 deals just like this and it's just a rinse and repeat deal. Because I know for me and my brother, we're always constantly looking at deals, because in terms of our bucket, there are deals that we typically want to see, because we normally don't want to focus on like core A plus investments that may have a smaller cap and not as much higher return, which is more of a more net worth, more um, let's say banks, insurance companies, just larger companies that are really focusing on those larger deals. We like to stick between 70 to 120 units, maybe something that's about 10, 15 years old that we believe we can bring value to. But it's also just understanding what market it's in. You want to make sure it's in a good location. Location is key whenever you are looking at deals. And ultimately, just buying into the strategy and the game plan. Either if it's just me and Jacob working on ourselves, of looking at a deal, of feeling 100% bought in and confident whenever you are getting into that deal. because there's so many deals to look at. But once you start connecting with the sponsor or other investors that are also investing in that deal, and maybe another investor who's invested in a previous deal with this sponsor, of just hearing what their values are, what their goals are, what their past performances are, and really just trying to understand the strategy is one of the biggest keys whenever you are looking at deals, because you want to be as confident as possible whenever you are going into a deal. You just want to be throwing your money into the stock market with some unknown company that you have no idea about what's going on with that company, what they're doing. You want to know everything you can to ultimately put your trust in them to then go forward with and know that they're going to do everything they can to really get you the best return as possible on your money.
Okay. Do you have anything as far as like location, certain markets? And then, yeah, I would say those two things.
Yeah, I would say right now we're focused, at least in our co-GP rule that we're currently working on right now, we're working on our own backyard, which is always the best place we tell people to start. So we're currently, for our co-GP rule, we're looking at the Scottsdale, Phoenix MSA. So constantly looking around northern Scottsdale, maybe just outside of Phoenix, for that certain aspect that we mentioned of falling in to our unit size, really in our dollar amount, if it's more updated or if it's a value add B class property, because you don't want to grab anything really at the bottom of the barrel. You want to make sure it is a good property in a good market. But as a limited partner, we constantly get deals, and if there's something that really sticks out to us, and I know couple of our limited partner deals right now are in Nashville, Tennessee, and we have family right outside of Nashville. We have a lot of family not too far um, in Chattanooga, Tennessee. So we're constantly in Nashville. We love Nashville. We know how hot of a market is right now. Even a few years ago, just seeing what this city could be. And I know last time I went there, it's just cranes in the air like nonstop. So the city is growing, and just seeing what market rates are there, and really how development and really just the influx of population, how that's going in Nashville has been great to see. So, and then also the sponsor who we worked with is our mentor. So really being able to trust him. I mean, everything we've been learning is through him and through a couple other individuals, but our full trust is in him. I've seen his past performances, his past deals. I have family that's invested with him prior, and just seeing his track record is unbelievable. So really just trusting anything he touches is pretty easy for us.
Nice. So we talked a lot about the process of investing in multifamily value add. We talked about some of the benefits as far as the tax benefits, depreciation, the superior risk-adjusted returns, the diversification outside the stock market. Are there any
Mhm.
other benefits that you would mention to folks as far as why they should invest in multifamily?
I just think the way you look at it in terms of, like you mentioned, a risk adjusted return, the benefits outweigh, such as the benefits outweigh other asset classes by, for me, it's a landslide, because just the amount of benefits to risk that commercial real estate really offers. Because if you listen to any podcast or really hear any high net worth individual person mention their investments, the number one investment they always talk about is real estate. And I believe it really is the key to that generational wealth, because it just compounds over time if you keep reinvesting your profits into a new deal, or just if you keep adding through your salary or any passive income that you have. If you continue building your real estate portfolio, you'll be able to retire early. You'll be able to really just take oh, you'll be able to take more time with your family. Because I know that's one of the biggest thing we got into this. We saw our mentor just taking so much more time with his family. He doesn't really focus on money. It's just one of those things where whenever you commit to it and you constantly keep at it, it's going to pay off over time. And like I said before, once you invest in that first deal, you're going to want to invest in 10 others just like it, and you're not going to want to stop. And just because you're going to see the benefits between the stock market or bonds or mutual funds, whatever most people are interested in, and they really don't think, they may think real estate investing is, oh, just buying a house and renting it out. There's so many different avenues, like we mentioned, of asset classes, let's say of storage, retail, industrial, multifamily. There's so many different ways that you can go and really have great returns that a lot of people just don't think are attainable. So for me, it would just be those people who may be on the edge or really don't think about it too much, of not even think about their investments, is it can set up your entire lifetime just starting with one investment and seeing what that does, and then going from there continued investments, and it just builds. And that's really what we try to focus on for our podcast as well, is just getting knowledge out to those people who may not even know about commercial real estate investing and the benefits it can have.
Okay. So I know since 2012, I believe when the Jobs Act came out and you could start advertising to accredited investors, start forming 506c syndications, the syndication world has grown a lot. It's not an opportunity
Hmm.
that a lot of our parents or families or friends could invest in because you just couldn't hear about it unless you knew someone in the industry. And so I feel
Exactly.
like in the last decade, there's been a lot of hype. And it's also coincided with one of the longest bull runs in, recent history.
Hmm.
But the music always, I think the saying is the music always stops. So,
Yep.
and we've seen that with some deals in the last few years with interest rates going up. And we've seen people get foreclosed on, capital calls, past distributions, things like that. What are the risks that people should be aware of when they're investing in multifamily? Because a lot of times, syndicators, operators will make it sound all peachy, say things like, oh, people need a place to live. It's the oldest investment till time. 90% of millionaires are made through real estate. But it's our duty as syndicators, operators to also educate investors about the risks so that it's just this unicorns and butterflies world. So what would you say the risks are of investing in multifamily and how do you mitigate them?
Yeah. So I would say, I mean, there's inherent risk in every investment you make and with everything that you do. But ultimately, the biggest risk that we've seen is you just want to make sure, ultimately, location is key, and the property itself, of really understanding the strategy that you're going to take on. I know there may be a little bit more risk. Let's say going down the if you're going on the development side, and if you're doing developments and you're going ground up, there's definitely a lot more risk that can come into play because you can run into coding problems or just anything with the city if anything goes wrong, which are some pretty big factors that come into play with development. But then if you are looking at it from a value add opportunity, because inside multifamily, there's also so many different strategies you can really focus on. Because if you just focus on the institutional buyers who buy these brand new buildings in A plus markets at a pretty low cap rate, but a high price, I mean, there's de-risking because they know how profitable these apartments are throughout the years. So I would say that's a thing, is the cap rates, and understanding cap rates to risk is something that investors should focus on, because yes, with a higher cap rate can come a higher return. With the higher cap rate, higher risk, because you can get let's say a suburban apartment complex. Maybe it's not in a great area and you think, oh, I could fix this thing up, but doing no research, no due diligence, not really understanding the market or the market analysis is a key focus because you want to make sure it's a property that's been profitable and it's a property that can continue being profitable. Because I know for ourselves and my brother and all of our investors, we want to make sure that the property is cash flowing day one. That's something that we want to see because with everything that goes on inside of a real estate syndication, another thing is the sponsor track record. You want to make sure that the sponsor is vetted and has maybe done a deal like this and they've done prior deals where they know what could go wrong, what they would do to get out of that, and ultimately how they're going to get to their end goal. Because just trying to figure out whenever, and that's one of the things while you're underwriting as well, because you want to be sent a deal, but also, I mean, you can just take the numbers at face value if you want, but that's another thing that could get you into risk. You want to look through the deal, underwrite it yourself, and fully understand what you're getting yourself into, because you want to understand that whenever you're constantly, while me and Jacob underwrite properties, we underwrite at worst case scenario. Okay, if we just want to break even, what do we have to do or what happens? Or let's say a ton of the tenants move out, or if just things go wrong, just different variables you're just constantly underwriting to figure out, okay, what can we do if this happens? What do we have to do? So I think the biggest thing, I know I kind of hit a few different points there that were kind of all over the place, but I think what it mainly comes down to is doing the due diligence yourself and just not fully trusting what you're getting at face value because there could be some random guy who's starting a syndication that, hey, there's this 30 unit apartment complex or down the street, and I want to bring a syndication and have investors put their money into this. And maybe I have zero experience and I have, I just think I can go in, purchase the property, and just increase rents, and nothing's going to happen where ultimately you want to know, okay, how you're going to get there, what's the strategy, have you done this before, what could go wrong, what are you going to do if this goes wrong? And that's always conversations that myself and Jacob have with investors or sponsors prior to investing in a deal. And it's whenever you're investing in a deal, you just don't want to, you can't just throw your money at it. Where you want to be asking those questions, you want to get a full understanding of what the strategy is, just so you can be confident in going into that deal because things go wrong. There's always something that comes up, and just being able to know what could happen and what you're going to do to overcome that is a huge focus as a sponsor and commercial real estate syndicator.
Got it. Okay. Well, with that, let's get into our closing questions that we like to ask everyone. On your
Awesome.
journey so far, and describe a time that you, sounds like an interview question, but a time that you failed. I can't even ask it without cringing. But yeah, in your investing journey, a time when you failed, preferably in value add, maybe one of the LP investments that you made, or if, your mentor has stories, but let's try to keep it to value add. And then what did you learn from it?
Yeah, I would say one of the biggest failures, I mean, luckily for me, I haven't had any big failures, so knock on wood, just praying to keep it that way. But hiccups throughout investments that we have had that come up is working with certain property management teams or contractors of just being able to understand really who you're partnering up with is another key focus that I mentioned because maybe something goes wrong with contracting where they're not dependable or they're being slow if it's a ground up development, if something is going wrong, but they're really not willing to go out of their way to fix it or get something approved or really go above and beyond. So I know for myself and Jacob, when we were in a deal, there was just a problem of really getting everything executed on time in in a timely manner. And it was a little bit of mix between the property management and contractors, like I mentioned, of being able to get units done in time, but also have the property management team who just wanted to fill units. They didn't worry about really trying to get the best price or maybe didn't really focus on doing their best job, honestly. So, and it was really in COVID because at that time, maybe people are a little weary. They don't, weren't sure what they wanted to do. And especially from the online work of maybe people taking a step back of really fully understanding who you're partnering with prior, I think is so key because you want to know that they have your best interests in mind and they're working just as hard as you to pursue the end goal as much as you want. Because, and that's another thing where you just want to make interests align where, let's say, if property management gets rents to this amount, they get this much benefit in the back end, or maybe they get it a bonus of some sort. So ultimately, just making sure the people you are partnering with are like-minded individuals and want to succeed as bad as you, I think is one of the biggest key focuses to really hone in on whenever you're investing in a real estate deal.
Got it. Okay. Let's see. For those who are just getting started in investing in multifamily value add, what's the biggest fallacy, falsehood that they should be aware of?
I think it's that they can't get into these real estate syndication deals. They may think it's only institutional investors, insurance companies, BlackRock, banks that are investing in these large complexes and really don't even think that they can invest or in these or that it's an inattainable item. Because, I mean, you drive around in a nice neighborhood, maybe city, and you just see these large, beautiful complexes. And most people don't even give it a second thought of, hey, that's something that I could invest in. Or I don't know. For me, it's crazy to think now because now I'm sure everywhere I drive, I see a nice property. I'm wondering, man, like what are those rents? What are they paying per door? What's their strategy that they're trying to do? Or maybe there's a ground up development and those wheels constantly start to churn of really, I don't know, just that investment perspective of really taking control of your money and taking control of what you can really pursue in your investment career. So for me, it would be don't put it on just some pedestal that you think is you're never going to get to. You don't have to purchase the whole property yourself. No one does it, not even these larger companies. It's all about pulling investor capital together into a group and just saying, you know what, I could be a part of this group, just trying to figure out what the minimum amount is to get into that fund, and then just taking it from there and seeing where it leads you and seeing the benefit that you're going to receive in the long run. So really putting that out for anyone listening and really anyone that's maybe on the fence about real estate investing is it's something that you can do. I know me and my brother never thought that maybe we'd be getting into this at such a young age. As I mentioned, whenever I first came onto the this webinar of whenever I thought I had to go to medical school first, and then I had to earn a high salary, and then I could start investing in real estate. It doesn't take that long of a time. You can do it now, no matter what you're earning. No, it's just going to be a benefit in the long run. So I would just really want people to just try to dive in, and I would say learn and do get your education, read as much as you can, listen to podcasts, and just take as much in as you can to feel confident going into your next real estate syndication deal.
Yeah, definitely a good point. I would say that, to get a little more specific, minimum investments usually in these syndications is $50,000. You don't have to be a millionaire or a billionaire to invest in these. So it's a lot more accessible than you think. And a lot of people will think about buying single family homes in their area to invest, but with where housing prices are right now and the down payment that you would have to put,
Right.
oftentimes the syndications, like especially if you're living in New York or the Bay, oftentimes the syndication investment is a lot cheaper. And with that same
Hmm.
down payment, you could diversify into multiple investments. And
Exactly.
then and then the other thing is that you can use your retirement accounts as well, right? So if you don't
Yep.
have cash lying around, if you have a 401k from an old company that you
Cash it out. Cash it out.
exactly, or you have a Roth IRA, you can convert it,
Yep.
roll it over into a self-directed IRA and use those funds to invest and keep a lot of the same tax benefits as a retirement account. I'm not a CPA,
Yep.
but that's my understanding. You could
Me
diversify,
neither. Me neither.
yeah, you could diversify your retirement funds outside the stock market that way and invest also. So definitely a good point.
Yep. Yeah.
So lastly, Aaron, what's the best way that people get in touch with you, learn more about, and just keep up with what you're doing?
Yeah, I would think the easiest way would be going to our website at twinluxcapital.com. Myself and my brother's emails are both on there. You can also find me on LinkedIn, and I'm always putting out content, really trying to reach the same audience that you're trying to reach, of getting listeners more involved into the world of real estate investing, and just getting that knowledge out and really helping people feel more comfortable in the world of real estate investing. So yeah, either twinluxcapital.com or Aaron Thomas on LinkedIn. My email is on my website as well. So if you want to find me on there, that's always a great spot. And then also on our website, we have a free ebook, which is just diving into the world of real estate syndication as well. So that's another great resource for anyone interested as well.
Okay. Yeah, we'll include those links in the show notes. And
Perfect.
yeah, so to learn more about multifamily investing, how the deals work, the benefits and the risks, feel free to reach out to Aaron at the contact information you just mentioned. Aaron, thanks for joining us today and educating us about multifamily investing.
Appreciate it. Yeah, thank you.
Yeah, we've learned a lot of great stuff, including how these deals are put together, the benefits and the risks, and how Aaron specifically looks at these deals. So, for those of you listening at home, also thank you for joining us today. Don't forget to like and subscribe to our podcast, Investing for Generational Wealth, on whichever platform you're listening to make sure that we can continue bringing you the best educational content. Thanks, everyone. And until next time, keep learning to invest for generational wealth.